CaesarBusiness.com podcast with Tony Rourke and Kevin O'Flaherty.
CaesarBusiness.com, making you money.
Share it on Facebook, share it on LinkedIn,
Twitter, our blogs, YouTube videos, listen to our podcast, getting so hot that it's burning up the stereo.
Welcome to the CaesarBusiness.com podcast. My name is Kevin O'Flaherty from O'Flaherty Law. I'm joined by my co-host Scott Mathis from Plateau to Peak Consulting. And our guest today is Bruce Anderson from SGC Investment Management. And he's going to talk about diversifying your risk and not your assets. So thanks so much for being here with us today, Bruce.
Kevin, thank you.
Why don't you tell us a little bit about what you do?
Well, it's a different story, to say the least. My partner and I started our firm about 6 years ago. We came out of one of the major wirehouses. When I say wirehouse, I mean like a Merrill Lynch or Morgan Stanley or UBS. And we've been working together for about 15 years. And as you know, in the last little over 15 years, we've gone through some wild rides in the market, and we started challenging some of the basic principles about investing a long time ago, and eventually it got to the point where in order for us to implement what we believed was the right way to invest, we literally had to strike out on our own to do that. And so we started our firm, and it was with the principle of most stories you're going to hear when you go to just about any investment shop, whether it's a registered investment advisory firm like we are or one of the major powerhouses. They're going to talk to you in terms of modern portfolio theory and diversifying your assets through the primary asset classes. So you're going to have stocks and bonds, and within stocks you're going to have large cap, small cap, mid cap. You're going to have international exposure, and within bonds you're going to have government bonds and corporate bonds and agency bonds. And the theory is that you diversify through those asset classes, and you're compressing volatility down, and you're just smoothing the ride up. And most of the time it kind of works, but when you need it to work the most, it fails. And we've learned two very difficult lessons over the last 15 years. In 1999, we saw the peak of the tech growth going on in the country, and the bubble burst. And in 2001 and 2002, we saw people losing, if you were an all-equity investor, you lost 50% of your asset value. If you were all into tech, you lost 70 or 80% of your net worth. And if you were in a diversified portfolio following modern portfolio theory, you lost 30. And advisors would say, hey, listen, the market's down 50, but you only lost 30. Well, it doesn't make you feel real good when you're down 30.
It's still a lot of money.
Right, absolutely. And it's a long time to claw back from out of that. And then we saw it happen again in 2008. We had the credit crisis, and the market lost half its value again. And you don't have to do that too many times, like getting hit in the head with a baseball bat. Eventually you just don't want to do that anymore.
Sure.
So we were thinking long and hard about how we would handle money differently than the traditional approach of modern portfolio theory. And modern portfolio theory has been going on since the 1960s. Dr. Harry Markowitz won a Nobel Prize for the whole process. And but it just didn't resonate with us. So what we did is we left and we started our firm, and we built a process that's really premised on diversifying your risk, not diversifying your asset. And modern portfolio theory theoretically diversifies risk, but you're only working within the world of one risk. There's different types of risks out there. So as we classify it, we have what we call beta risk, which is traditional market risk, exposure to stocks and bonds. And that's a relative return strategy, and it's going to move directionally with the market up or down. And you're really at the whim of the market. And there's a lot of brilliant people out there telling you what's going to happen and why things are going to happen, but the reality of it is nobody knows. We don't know where the market's going. And you have to admit that first before you can really get to the next step.
And so most people who are investing according to modern portfolio theory, they're doing the group think of investing are exposed to the beta risk that you're talking about.
Well, beta risk is groupthink. I mean, that's at least in our opinion. And we're kind of taking and defining beta a little differently than the classic sense. But it's beta, it's relative return, it's investing in stocks and bonds, and how you have it allocated between stocks and bonds will define how much capture of the upside you get and how much capture of the downside of the equity markets and the fixed income markets. But the reality is nobody knows where they're headed or why they're headed in that direction. And a lot of people try to sound very intelligent and saying why that's going to happen, or especially after it happened, they talk about why it happened, and they get real smart after it happened. Hindsight's a wonderful thing. But nobody knows. And so what we embarked on was trying to come up with a process that we could eliminate a lot of those unknowns and in doing so the downside risk. And we landed on looking through a prism of diversifying your risks. So in addition to beta risk, we have two other risk silos that we work with. We have what we call alpha risk, or just alpha investing, and then we have defined risk. And I'll talk a little bit about defined risk in a minute because that's pretty interesting. But alpha is nothing more than absolute return. So I talked about relative return with beta.
Define relative return for me.
Okay, relative return is that you're going to return, your return is going to be relative to how you're invested in stocks and bonds.
Okay.
Okay, and it's going to move directionally with stocks and bonds, and so how you diversified through those two major asset classes and then the sub-asset classes are going to determine how you move, but it's relative. Your returns are going to be relative to how those two areas move.
Okay.
Absolute return, on the other hand, which is the second risk silo that we focus on, is a return expectation where you're expecting to get a positive rate of return in any 12-month period, regardless of what's going on in the traditional markets. So absolute and relative, two different types of risks. And then the third risk silo we work with is what we call defined risk. And there's ways and tools you can use to define risk. And a lot of this, the structure that we use, it's been around since 1999. Most people aren't even aware of it. And I'll talk about that in a minute. But once you start looking at investing through diversifying risk, it causes you to think and act a lot differently. Mm-hmm. And so we just never want to participate, or at least limit how much of the downside we participate in, and we want to get a reasonable return on the upside. We're not looking to hit home runs every day, but we want to get a high return on risk. People typically look at what's my return on my investment, or what's my return on my assets. Well, we'd argue that's the wrong way to look at it. You got to look at how much return you're getting relative to the amount of risk you're taking. And so you go out there and let's say you're looking for a vehicle that returns on average 8% a year in, year out, and you're happy. And there's tons of them. You can go find, whether it's a blended portfolio of stocks and bonds or a stock portfolio or bond portfolio, you can find investments that over the long run have gotten you 8%. But that's where most people stop looking. The most important factor, and that's above the line, that how much you got on a return, but what's more important is how much risk you took below the line to get that return. And so you can have an 8% return, and you only took 3% risk, you had 3% risk exposure, and you've got another vehicle that gives you 8% return, but you had 20% downside risk exposure. Well, which one do you want?
Yeah, the 3%.
Obviously. And so what we do is try and create a diversified portfolio of risks so that we are building something that has risk that's very limited to the downside, but gets a reasonable upside return. And we want a high return on risk, and we want a reasonable return on assets. But we want limited risk, a high return on that risk. And if we successfully do what we're supposed to do, that's what we get, and that's what we've been achieving. So absolute return, people always think that typically hedge funds or alternative investments, and under that umbrella it's true, but there's a subset in there that we try to build. That's where I really can't get into a lot of detail because we work mostly with accredited investors and qualified purchasers. And
can you define those terms?
Yeah. What is it?
Okay, well, an accredited investor is somebody who has $1 million of invested assets or more, not including their primary residence. And that's just what the SEC has defined as being a sophisticated investor, which I kind of thought was kind of silly because I've met a lot of people that had $50,000 who are far more sophisticated than people we work with that have $5 million. But,
sure.
But that's how the SEC has chosen to define sophistication, and that's what we have to live by. So I can't tell you in detail anything about what we're doing or advertise on a public forum like this what we do unless I qualify every listener on this that they're an accredited investor. So I'm a little
that might be
hamstrung.
difficult.
So I'm gonna opt not to talk about the specifics. If anybody wants to learn about it, we're welcome to talk. We'd be happy to talk to them, tell our story. Most of what we do requires that you be an accredited investor or a qualified purchaser. A qualified purchaser is defined by somebody who has $5 million of investable assets or more. And then some of the other things we do don't have restrictions, like the defined risk silo that I was talking about. I can tell you the background on that. It's an account structure called a portfolio margin account. First thing people should probably do when they hear the word margin is all of a sudden become very skeptical about what I'm talking, because margin is borrowing. You're borrowing money to do something else with it. You can borrow money against your investments to buy a car, you can borrow as a down payment on a home, or you can borrow it to invest more.
And the problem with a lot of margin accounts is that if your equities drop below a certain level, you're forced to sell them in order to cover
sell them at the wrong time, and so there's a structure where that doesn't happen. And if you Google or look up portfolio margin accounts, it's an account structure that was put together by Goldman Sachs in 1999, and it was approved by the SEC for their institutional clients back then. So it was for their largest investors.
Sure.
And basically, what the premise is, it's all based on risk. It's risk-based margin. So the tighter you can define risk down in absolute terms, the broader the margin limits become. And most people think in terms of Reg T margin, which allows you to borrow about 50% of the value of your underlying investments. And what people would do is they borrow and they'd lever up, and as you say, if the market turned the wrong way on it and they fell below the collateral requirement of that, they would have a margin call. They'd either have to bring more capital in or they'd have to sell the investments they have at the worst possible time. Mm-hmm. In the case of portfolio margin, you never run into that barrier. And you're not limited to just 50% of the value of your investments. You could lever up 2, 3, 4, 5 times, as long as you can define your risk down. And so what we've built is an interesting approach that people that have highly appreciated concentrated positions of stock, so these would be executives that work for big companies, and over their careers they've amassed a lot of shares at very low cost basis. And the last thing they want to do is to sell that position because they got a huge tax liability that they have to pay. So, it could be, depending on their tax rate, it could be very hefty. It's at least 15%, probably 20 or more, depending on their income. And so they go to advisors, and the first thing an advisor is going to say to them is, well, you got to start selling and you got to start diversifying. And we go, we'll say the exact opposite. We'll tell them and advise the last thing you want to do is sell your stock, unless you want to. If you want to sell it and you need it, you're going to fund some other major purchase, great. As long as you understand the tax consequences in that. But for normal investing purposes, you do not have to sell to be able to diversify. And you can do it in such a way that you've actually reduced the risk of just sitting there and owning the stock. And how that works is that within a portfolio margin account, we could bring the concentrated position in, and we can protect the downside by using an equity option called a protective put. What you're doing is you're effectively buying insurance on that stock. And so you buy the right to sell that stock to some other person at some point in time at a specific price. Once you have entered into that contractual agreement, and it's a market agreement, there's market makers out there, and the markets manage that. Now you've defined your risk.
Because there's a certain point where if the stock goes so low, the insurance that you bought basically kicks in, and you're
sure. So what you do, you buy a stock, or you own your stock, and say it's $100 a share, and you buy a protective put at $95 a share. That stock could go to zero, and you'll still get the value equivalent to $95 a share for that by the end of the contract period. And then you enter into a new contract, and you keep rolling these out. And it's a fairly expensive proposition, but it's like buying insurance on your car, buying insurance on your home. You're insuring the value of your stock. But if you just do that year in, year out, eventually that cost adds up. So what you can do inside of a portfolio margin account, now you can borrow against that defined risk asset, and you can lever up. And so you can take, so if you have $1 million of a concentrated position and you define as risk, now you can borrow $1 million, $2 million, maybe $3 million against that, and build a diversified portfolio of stocks. And every one of those positions is also defined, the risk is defined by a protective put. And so what we do is, let's say you take that $100 stock and it's paying a 3% dividend, and you go buy 2 or 3 times as much more in additional broad, diversified portfolio of stocks like it in different asset in industrial sectors, and they're paying maybe a weighted average dividend yield of 3%. And so now you're getting dividends on, instead of $1 million, you're getting dividends on $2 million, but you have less risk than just sitting there with the original stock doing nothing at all, because every single position has a floor on it. Every single position has a put on it. And by doing this in a levered format, the amount of income you're getting and the total return, which would include the income and the capital appreciation, will typically pay for the cost of the put and the cost on the concentrated position, and the cost of the put on the diversified positions, and you end up getting a higher rate of return than just doing nothing at all. So it makes this position work harder for you. You don't have to sell, you don't have to pay the taxes. And for somebody who's going into retirement with a concentrated position, from an estate planning standpoint, it works in their favor, because now they can carry that through and pass on that concentrated position to their heirs, and their heirs get the stepped up cost value of that stock upon that person's death, and there's never any taxes on the appreciation that they have to pay.
So when it goes to their heirs, just to kind of elaborate on that, so when it goes to their heirs, if they were not to pass away and it wasn't being passed to their heirs, they just sold the stock, they'd have to pay capital gains on the difference between what
Correct.
they purchased it for and what they're selling it for.
Correct.
When it goes to their heirs, when you say there's a stepped up basis there, when their heirs sell it, what they purchased it for, quotation marks, when they inherited it, is the value when they inherited it, not when their dad purchased it. So they get to not pay tax on those capital gains.
That's correct. So that $100 example I was using, let's say that the average cost basis of those shares was $5 because they've accumulated it over a 40-year career, and they got an average cost. But if they sold it, they'd have to pay capital gains taxes on $95. Well, by not selling it and waiting and passing that on to the next generation, let's say that same $100 stock was $100 when they passed. Well, the cost basis for the next generation now becomes $100. So they would only pay taxes on the growth of that stock above $100. They'll never pay taxes, won't have to pay taxes on that first $95 of appreciation. So
that sounds great.
Yeah.
So what you're doing here with this strategy is because you're leveraging everything, you're allowing yourself to make more money because you've turned $1 million into $5 million through levering it up.
Yeah, we probably wouldn't go that much, but you could. I mean, in theory, you can lever this out 40 times. I wouldn't suggest you do that.
But usually people are worried about leveraging because of what we talked about with margin accounts, where you risk selling everything at a poor value. But because you're buying these puts on the stock, which are basically insurance, and you're using the leveraged position to pay for those puts, you're actually getting the potential for more money with less risk than if you just went out and bought the stock.
That's exactly right. You got it perfectly. Yeah. And you can't get yourself into a margin call situation where you have to either deliver capital or sell the underlying assets, because the value of the puts, as the stock's going down, the value of the puts is going up and offsetting. There's a delta in there, what we call a delta. So the movement of the puts doesn't correlate directly with the decline of the stocks, but over time it will, as time value erodes, or what we call theta erodes, time value eroding. So you never get into a margin call situation, because the value of your portfolio, which is the collateral for this, the net asset value, can never decline to a point where it falls below the required collateral value that you have to maintain it. And so it's a great tool. And it wasn't approved for retail until 2007. 2008 occurred, and everything froze. Nobody was doing anything. And the wirehouses and the typical investment advisory companies, they won't put this tool in the hands of the typical advisor, because you have to have the right kind of strategy underneath it to make it work. And so
So you actually have to be working through a hedge fund to do this?
No. This is what I described is not a hedge fund, because I couldn't have described it if it was.
Okay.
No, what that is, it's a separately managed account that will run. So,
but you need a professional to run this. You can't just say, "Hey, I like that strategy. I'm going to go do it on my own."
Well,
in order to get that leverage.
It's not necessarily rocket science. You could do it. We do it through interactive brokers, and if you understand what you're doing, you can do that. But there's pitfalls in there. I mean, you got to know what you're doing. You got to know how to when you go out and you take, if you have $1 million portfolio and then you're levering that up by another $1 million or $2 million, you're buying a lot of stocks, and so you're making big investment decisions. And so what we do, and we have two phenomenal traders in our firm. My partner is one, and then another gentleman. They collaborate on this, and they're identifying what we would call low risk entry points, stocks where, based on a fundamental and a technical analysis, that we believe there's a high probability of upside and a low probability of further downside. So what we're trying to do is put the probabilities of success heavily weighted in our favor. So we're buying at low risk entry points, we're putting the protection on, and then if we're right and the stock goes up, then eventually we may even sell a call on that, which is another income stream we can get. So opposite of buying a put, where you're buying insurance, you're selling a call, you're selling the right for somebody else to buy your stock from you at a higher price. And they're paying you for that right. So it becomes another income stream. So you got an income stream from the dividends, an income stream from the calls, and then you've got a cost, which is the puts. But the income streams are typically paying for the cost of the puts, and you're getting the levered capital appreciation of the portfolio, and your risk is a fraction of what it would be had you sat there and just held your concentrated position and done nothing.
Now, I understand how puts work.
Okay.
And I'm not a complete rookie as an investor, but I don't understand why, based on my understanding of what you said a call is, where you buy it at the right to buy a stock at a higher value than it is right now. Why would someone want to buy a call? Because couldn't they just buy it when it goes up to that value?
They could. So typically people who trade in the options world aren't interested in owning your stock. They're not interested in buying or selling long or being short a stock. What they're interested in is just trading the option value, and you're just taking advantage of the fact that that market exists. So there are people in there trading calls, and so they're going to sell a call or they're going to buy a call. So what they're buying is, if they buy the call, they're expecting the underlying stock to go up in value, and they can sell that call back to the market for more than they bought it for. So they can, for pennies a share relative to the price of a share, they can control a big block of stock. So you can go out and buy a $50 stock. You can control 1,000 shares of a $50 stock for a few $100 by using the calls, and then you get typically, if they're right and they're buying a call and the stock goes up faster, well, the value of that call is going to go up dramatically too, and the rate of return on that call contract is greater than the rate of return on the underlying stock, and they'll just sell that call contract back and they'll make a lot of money. And so they control a lot more stock with a lot less money.
But the downside to a call is that there's a time limit where that call will expire. And
all option contracts have a time limit, yes. So whether you're buying or selling puts or buying or selling calls, they're contractual periods. So it's as short as, they have weekly option contracts now. There's more and more stocks have weekly option contracts associated with them. Monthly, they go out to the next month, the quarter, and then often the quarter after that. Then you can go into what's called leaps, and you're out a year, maybe 2 years. And so the combination, the value or the cost or the income you're going to make on options are determined by three primary factors. One is the amount of distance between the underlying price of the stock and the strike price that you're setting. So the closer the strike price, the more that cost factor comes into play, because it doesn't have to move that much to get there. Further away, then it's less cost.
Now the strike price is the price where if it hits that point, that's when you're in the black with your purchase.
Depending on what side of the trade you're on, yeah.
Okay.
I mean, so you're in the money. So if that $100 stock, if I sold a $110 call, it's in the money. Once the stock gets 110, I don't participate in any more of the upside, but I got paid. I got paid to give up any more upside than 110, or that $10 difference. So there's a strike price. There's the volatility of the stock. So the more volatile the stock, the more costly the contract will be, or the more income you'll make on that contract. And then there's the time value. So the longer out, the more time you give that stock to reach that strike price, the more it'll cost, or the more you'll receive for it. So those three elements determine the value. And so all we're doing is just participating in the fact that market exists. And so when we own stock, we'll never go naked on a stock. That's dangerous. So that means you don't own the stock, but you're dealing. And I could sell a call today on a stock, that $100 stock, for 110, and if that stock goes above 110, I have to deliver the stock at 110. Well, the danger there is if I'm naked, if I don't own the stock, and that stock goes to 150, well, now I got to go buy the stock at 150 to deliver it at 110.
I got you.
And so I want to own the stock. I don't want to be naked. I want to be long the stock. And so when we won't sell a call unless we've entered into and bought the stock and it has appreciated. So now we can set a strike price that's higher and oftentimes get a premium that's greater than had we sold the call right away when we bought the stock. So we're patient on the upside call. Right away, though, we'll buy the protective put so we don't have any downside risk.
Okay.
Kind of complex.
Yeah, you could say that.
But it takes, we watched everything daily. We only have about 15 positions on at any point in time, in addition to the concentrated position. And so we can manage that. But the average investor, there's a big learning curve here, so I wouldn't encourage somebody to do it. But it's available to them. They can go open up an interactive broker account and put in a portfolio margin structure, and they can start doing it. But I wouldn't suggest it.
Yeah, it sounds like there are a lot of pitfalls to that if you don't know what you're doing.
Right.
So when you're talking about diversifying your risk, is that when you say diversify your risk, you're talking about just putting these puts on stocks, or what do you mean by diversifying your risk?
Good question. It's those three risk silos. So if somebody came into us with $1 million and we would suggest that they probably would put some in what we call the beta silo.
And that's the relative one, so
That's
it
the
goes up or
relative
down
return.
based on what the market
Whatever
does.
the market's doing.
Okay.
Right? And then the absolute one, which is what we call alpha. So we expect a positive return in any given year. It's very low correlations to the traditional market, so we expect a positive return. It's slow and steady. We're not looking to hit home runs. We just want to get, there's only two things we know for certain in this whole game. One is that time's going to pass and that compounding works. Everything else is a guessing game. And so what we want to do is put ourselves in the way of those two principles.
So just so I understand what absolute or alpha risk is, would a CD be absolute because after a certain amount of time you're contracted and it's going to go up?
Yeah, but
exactly.
I would almost create a fourth risk silo with that, and that's cash equivalents, CD.
Okay.
So there's very little or no risk, implied risk there.
What's an example of an alpha or absolute type of risk?
Well, oftentimes hedge funds, low volatility hedge funds, I'm not talking about these speculative hedge funds you read about in the paper that blow up because they're levered 40 times out and the market moves 5% the wrong way on them and they're out of business. I'm talking about traditional hedging strategies that are not correlated to the market. Their success isn't determined by the market. It's determined by their executing a strategy, much like our success is determined by our executing a strategy with that concentrated position and the levered portfolio that's with it. So hedge funds and there's lots of them out there that are they have tremendous track records of positive return every year. They're not going to, if the market's up 20, they're not going to be up 20. They're going to be up, their goal of 6 to 8 to 10%. And if the market's down 20, they're very likely going to be up 6 to 8 to 10%. It's just a boring kind of slow and steady way of doing it. So that's what we call alpha or absolute. So we'd have somebody get into the beta sleeve, we'd have somebody in the alpha sleeve, and then we'd have somebody in the risk-defined sleeve, which is that example I gave you of how we protect a concentrated position and use leverage to do that. And so we diversified risk three different ways, whereas if you went into any of the wirehouses, you go into most other shops, you're going to get the same story. They may use different tools, but it's all about modern portfolio theory, diversifying your assets through stocks and bonds, and just hope for the best. And we don't want to hope. We kind of want to have some control over what happens.
Now, within the beta risk silo, do you still believe in diversifying assets? So you've got a layer of diversified risk, and within each of these silos, you're actually investing in assets.
Correct.
Do you believe that diversifying the assets is a good thing, or is it, within that beta silo, you just do a concentrated position in one or two stocks that you really like?
No, in the beta sleeve, it's going to be broad diversification, and we're going to follow modern portfolio theory. We've found a strategy that we really like in the beta sleeve, and there's a company out there called Stairway Partners. They came out of Brinson Partners, and they were one of the largest asset allocation firms and managers in the world at the time before the business was sold. And Stairway, what they do is they build allocations through stocks and bonds by projecting the forward 3-year earnings by asset class. So they'll look at large cap stocks, domestic large cap stocks, and they'll look at where the current earnings is relative to the long-term trend line of earnings. And if that earnings is plotted, they discount that 3-year projection back to a current cash number, and if that's on well above the current trend line of earnings, what they'll do is they'll start underweighting that because the assumption is it's going to revert to the mean, to that trend line. Conversely, if there's an asset class where the next 3-year earnings projection is below the long-term earnings trend, they'll start overweighting that asset class because they're assuming the reversion of the mean is going to bring the earnings up and the value of those investments up to the long-term trend line. And nothing's straight line. I mean, it's not linear, and it goes up and down, and everything cycles. And so you're trying to just allocate properly based on where you are in the cycle by asset class. And it's true for fixed income, and it's true for equities. And so what Stairway has done, and we went and back tested all their weightings. So we went back to 2008, and I said, where were you at the end of 2007 before this whole thing blew up? And they were actually underweighting the U.S. stock market because it had gotten up, it had gone too high. And so their future models were indicating that the future earnings projections on that were lower than they normally would be, so they start underweighting it. And so they were ahead of the decline, so this doesn't mean they weren't in that asset class, they just had less money in there.
Okay.
And so we looked at major turning points for all these asset classes, and whether they were turning up or turning down, we wanted to see where they were before, and then where they were after the turning point happened. And in almost every case, they were ahead of the turning point. So when we had that crash in 2008 and it continued in the first quarter of 2009, we wanted to look, well, where were you at the end of 2008 and early 2009 with these? Well, they had already started overweighting the U.S. market in the first quarter of 2009 before it started its ramp up, so they got ahead of it. And so we apply that model when we allocate in the beta sleeve using modern portfolio theory, where we're going to have, and we've got 3 different models. We've got an aggressive model, a moderate level, and a conservative model. The conservative model has more allocated to fixed income than equities, and conversely, the aggressive one has more to equities than fixed income. But we'll follow their weightings based on that long-term earnings trend line allocation. So we do have traditional investments. That's in the beta. When we get into alpha and risk defined, that's where we're really diversifying risk. So just in a plain vanilla allocation, we might have 50% in alpha, 25% in beta, and 25% in risk defined. And then we're pretty comfortable that we've allocated as efficiently, as effectively as we could, allocated risk. And in all likelihood, we put the probabilities that if we go through a major downturn, we're not going to feel too much of it. And if the markets just do what they've been doing, slowly, gradually going up, or just kind of range bound, we're going to make some money. And so we like that trade-off. We don't want to participate or find ourselves waking up someday for some series of events that have surprised us at a time that's also surprised us, and all of a sudden our investment is worth half of what it was a week or a month ago. And we just never want to go through that again.
So if I'm understanding what you do properly, you've got your hedge fund work that you do, but what we've been talking about is separate from that. This is just, wealth management for people.
Correct.
And someone doesn't need to be an accredited investor to work with you on the wealth management side, or do they?
No. What we do with every investor that comes in, we'll work out what we call a financial goal plan. So we sit down with them. We say, where are you today? What are your long-term goals? When do you want to retire? How much do you want to spend in retirement? We put a reasonable rate of return on their investments. We tend to use 5 to 6% a year, which is a moderate expectation. And then it's just one big giant math equation, and we see where they're likely to be at life expectancy. And for most people, life expectancy is the early 90s is what we use right now. Most people, the biggest fear they have is running out of money. So we try and allay that fear. And it's just nothing more than creating a peek around the corner for them and let them see, okay, here's where we are today. Here's what our goals are. Is there a correlation, or are those goals connected with your resources? And if they're not, it's better to find out now than 30 years from now. And then they can take actions figure out how to connect. Most people we find are better off than they think they are.
Do you have a low-end dollar amount that you, or any minimum that you want to talk to people about, or is it open to anybody that has just starting out, brand new family, whatever, or?
Yeah, no, we only deal with about 100 families, it's probably less than that, across the country right now. We don't have a hard minimum, but it's typically somebody who has $2 million in investable assets. They don't have to have them all with us,
Right.
but at least it puts them in the space that where our strengths are.
Sure.
Now, if somebody wanted to come in with less, and I'd be happy to talk to them and help them. And if it's not a fit for us, there's some good people out there that I can refer them to, and I'd be happy to do that. We can do a financial goal plan, but it's so important in this world to have a good fit, to have a relationship with somebody that you can trust.
Absolutely.
And that what they're doing works for your situation. And what we're doing might not work for everybody's situation, but there's other people out there. The one thing about this silly business is it's too easy to get in it. And there's too many people doing it that shouldn't be doing it. But there's some real good people out there. And you just have to ferret them out.
Yeah, it's hard for someone on the outside to tell, just like with working with a lawyer. It's hard for someone just by meeting me to gauge my skill as an attorney.
Sure, right.
And I'm sure it's kind of the same way in wealth management. It's all you can do is have that person educate you on what the strategy is, and if they can't explain it to you, then it's probably not a good idea.
What was that commercial? There was one recently on TV where the guy is sitting down talking to somebody, and at the end of the conversation he goes, "Would you trust me to manage your assets?" And everybody goes, "Oh yeah, sure." And it turns out he's a DJ, and he had long dreadlocks and everything, but he was able to sell them on the fact that I can manage your portfolio. Well, if you're a good salesman, anybody can go out there and create a moderate level of trust. But the key is you got to, and it's the onus is on the investor to try and make sure they're working with somebody who is truly has their best interest in mind, which is another reason we went independent. We're governed by a different standard than the typical wirehouse advisor is. So we're measured or governed by a fiduciary standard. We have to literally, anything we do has to be in the best interest of the investor. There can't be conflicts of interest that we have. And if we're audited or if there's a question that comes up, we have to be able to demonstrate that we didn't do anything because it was in our interest. We did everything because it was in the investor's interest. In the wirehouse world right now, and they're trying to change this, but they're governed by a suitability standard. And so at the time that the investment is offered and sold to the investor, it just has to be suitable to their situation. And whether there's conflicts of interest or whether there's other issues with it, never enters into the equation. And so it's just that higher standard. And so not only do we like to manage the risk properly, we like to manage the relationship, and we want to be on the same side of the desk as the investor. So we don't want ever to be a question, well, why are you selling me this product? Or why are you selling, is there a soft dollar arrangement? Are there other fees you're getting other than the fees you're charging me? In fact, we prefer, in some proprietary structures, our fee structure, we don't charge a management fee. We'll just share in the profits, but we have a zero management fee. We like that.
I haven't heard of that before. That's interesting.
Most sophisticated investors they'll get that. They go, because what people don't get is you're going to get paid regardless of whether I make money or not, and that's typically true in this business. Yeah, we're going to get paid, and we got to keep the lights on, and we got to hire staff and that. But what they don't want is just to consistently continue to pay the fee and not make money. And so there's some things that we have, can't do it with everything, but there's some things we have where we won't charge you a fee unless we've made money for you. And the only way we can get paid is if your portfolio is growing in that.
I like that.
Well, Bruce, if someone wants to reach you, how can they do that?
Well, we have offices in Naperville and Scottsdale. My partner runs the Scottsdale office. I'm here in Naperville. My number is 630-447-2760. It's SGC Investment Management. SGC stands for South Georgia Capital, which is an interesting story, how we got to that name. If we have time, maybe I'll go through that. But my email address is bwa@sgcim.com. And I'm happy to talk to anybody. I love telling our story because it's different, but I just got to make sure that I do it within SEC guidelines as far as who I tell it to.
Well, and for those of us who don't meet your kind of $2 million threshold, that's something to aspire to, and keep listening to podcasts, and we'll all work on that together.
That's right.
All right. Well, pleasure having you here.
Thank you. I
Thank
appreciate
so
it.
much.
This
Very
was fun.
informative.
Yeah.
Thanks.